Welcome to the daily update, where I'll go over the action in the market for Friday, June 28th, and then we'll see how things look for Monday, July 1st. Started off pretty well. We actually saw a real surge right at the open. We did hit upper end resistance. We turned, came back down. We filled the gap right at the unchanged level, and then we just kind of kept going after that and ended up closing pretty much at the low for the day. Right now, it just looks like a pullback. We have to watch some of these negative divergences and some of this weakness that's starting to come in. We need to respect those things, but at the same time, we're still above the 20-period moving averages. We're still looking like we're more or less in an uptrend, but going from here, we'll have to see, okay, can we get that positive side back? Now, Friday was the last day of the week, the month, and the quarter. And so there was some real gyration going on there. The whole Russell 2000 did a rebalance of the index. There's some window dressing going on, both positive and negative, where folks are buying the things that look solid. They're selling the things that are more weak. And we ended up seeing a pretty significant decline from top to bottom from what we've seen recently anyway. This is the last video that I'll do before I actually lock down the SPXInvesting Program. It has launched. I'll be rolling out a lot of things in July, some additional services that are not available now. I really wanted to use the month of June for people to look around. It also gives you early access to this video, the daily video, before it goes public right at the market close for that particular day. If you want to learn more about the program, please go to a link that's in the description below this video to see some videos about the program. And there's also a link that will take you to the website itself. Okay, let's go back and talk about what happened and then look at some charts. We did have a higher open. The core PCE came in and the market treated that as friendly. We ended up shooting higher. We got above R1 at 54.93, even above R2 at 55.04. So now we were dealing with that 5,500 level again. And it looked for a while that that was kind of the line in the sand that the market was battling with, but it ended up not lasting all that long. We didn't quite get up to R3 at 55.27. That's the level I was watching to see for overhead resistance. We didn't quite get up there. Then everything changed after that. Prices reversed. We fell back down below R2, R1, and the unchanged level. Now, this is more or less filling the gap. And so from this point forward, then the market had to decide, okay, we're going to see a nice bounce up out of this and get back some of those gains that we saw earlier in the day, or actually drift more negative. Well, we tried to find support. We fell below the unchanged level. We did go down to the daily pivot at 54.80. Then we fell down below S1 at 54.70. And we closed slightly above S2. And S2 was at 54.57. So we were down 0.41%. Not that big of a move on a day-to-day basis, but you look at the swing from the high to the low, and it was pretty significant. We were above average with volume, a big day for that, so that's not surprising. We're still positive for right now in the short, intermediate, and long term. We are still looking vulnerable. We still have negative divergences. We are seeing some weakness starting to come in, but for right now, the uptrends on all different time frames still remain intact. And then we want to pay attention to the geopolitical events. Really not much about the presidential debate that will influence the market. I know there was some little blurbs here and there, but it doesn't have that big of an impact, either positive or negative, on what happens in the stock market. And I know that's all what everybody's talking about right now, but it doesn't seem to really impact things much. Now, if things go further from here, that could end up coming into play. So we'll just take this as it comes and then see how the market reacts to that. Some comments. Small caps actually had a pretty good day. They outperformed. They were the strongest index of the day, and the Russell 2000 was readjusted. This is what they do every year to take stocks out and put stocks in. Negative divergences are still there, and in some ways, when we have a down day, we've been seeing a little bit of an improvement. Well, not much of an improvement on Friday. And then, is the strength actually continuing to come through, or is weakness starting to come in? We do have our stochastics chart. That's the only thing in the short term that is still extreme positive. They move a little bit slower. It takes them longer. Plus, I have three different time frames on that same chart, short, intermediate, and long term, that further subdivides the short term. We already have an oversold indicator. The Stoke RSI is extreme negative. Nothing right now in the intermediate term that is overbought. And we're still dealing with this scenario that the Fed is going to keep rates higher for longer. Inflation hasn't been coming down as much as they would like. And if there is a rate cut, it's looking possibly at happening in September. And there'll be one rate cut from what the market had been anticipating to be 3 rate cuts. Now, this can all change, and this could get pushed further out, and it could end up being no rate cuts in 2024. But we have to go with what the market is pricing in right now. The dollar was down. That did give a little support, at least initially, to stocks, but interest rates were up, and that put some pressure on stocks. We closed at 4.34% for the 10-year yield, where we had been at 4.29%. We're still inverted with the yield curves going on over 2 years now that the 10 to the 2 has been inverted. Sentiment did tick back down with the down day. We had been neutral at 46. Now we've slipped back down to negative at 44. We're still in a trending environment, and it's positive. The green line's on top, and it's actually going up a little bit. We're seeing a little bit of an improvement on that chart, and I'll show that to you. The bias is negative with the down day, and I'm still keeping our momentum at mixed. The market really seems directionless currently. The economic reports that came out, we did get personal income up 0.5% month over month. They expected it to be up 0.4%. So that was a little bit more than expected and up from the 0.3% we saw last time. Personal spending was actually down a little bit, being up 0.2% month over month. They expected it to be up 0.3%. Last time it was up 0.1%. The PCE price index was unchanged, or last time it was up 0.3% on a year-over-year basis, and the market took this as more friendly. It comes in at 2.6%, where last time we had this report, it came in on a year-over-year basis at 2.7%. This was the big one, the core PCE, which means that you take out food and energy, of course, the things you have to have. It was up 0.1% month over month. And last time it was up 0.3%. Year over year, this also declined. And this is what gave the initial strength in Friday's session. We're at 2.6% year over year, where last time we were at 2.8% year over year. Consumer sentiment came in at 68.2. They expected 65.6. So this was stronger than expected and up from the 65.6 that we saw last time. And the final reading a year for this month anyway was 69.1. And then a year ago, we were at 64.2. So if you look at this on a year-over-year basis, it's showing some improvement. And then this is what they break down inside of the consumer sentiment. When you're looking out in inflation, it came in at 3%, where originally they had said it's going to be 3.3%, where before that it was in the 2.3 to 3% range. So they're pushing inflation in the future up, but it wasn't as much in this latest reading. And then the inflation expectations came in at 3%, where we had a preliminary reading of 3.1%. So that ticked down a little bit. And they've held between 2.9 and 3.1% in 31 of the last 35 months. And then before the pandemic, the whole COVID lockdown, the long run inflation expectations were in the 2.2 to 2.6 range. So inflation is going up. And that's what a lot of people are really feeling when you go to buy food or pay rent or buy a house or buy pretty much anything right now. And then the Chicago PMI came in. It was better than last time. It came in at 35.4, which is a very bad reading. It still came in under 50, so it's showing contraction in the Chicago region, but it came in at 47.4. All right, some charts. Here is the personal income and spending year over year. The blue line is the spending, where it's just slightly above this 5% level here, but coming down a little bit, and income is actually underneath. So we're seeing income not really keeping up with spending currently. Then this is what the market really pays attention to, the year over year PCE core inflation, where it is continuing to come down. It's still above this 2.5% level though, but it is declining, and the market liked that. Then personal spending month over month, where it did increase. And then the Chicago PMI, where we had a really bad reading back in May. The latest reading was still under 50, but showing some real improvement there. And then consumer sentiment, where this is different from the chart that I show, which will be next. The blue line is, and they're kind of all bunched together, so it's a little hard to read. The blue line is the total reading, where it's coming down, and the expectations, that's looking out into the future. That's the yellow line, are ticking up just a little bit, and the purple line is how people are feeling right now, and that is declining. Here's our chart, just to show you compared with the 2-year yield, where we have been showing a real improvement as far as consumer sentiment. Lately, it's been coming back down. Here's some Isabel Net blog charts where we take real S&P 500. That means inflation is calculated into this, and then different historic events that have happened. Here we go back to the 1929 crash, the peak of the roaring 50s and the financial crisis and blah, 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 blah. You can just pause this and look. And notice here they're putting in the QE era. This is something that they promised they would never do, but now has become an expected part of the markets. And I'm going to be doing some supplemental videos on this that'll be available to members. There's some positive things to this. Of course, that tends to really stimulate the stock market. And there's some real negative things too, because was the Fed ever necessarily meant to do that? So you can take a positive side or a negative side. And then where do you see the S&P by the end of this year? Most people think we're going to be between 5,500 and 6,000. Okay, you might as well throw a dart at the board as far as I'm concerned. And then this is kind of a longer term chart too. It says returns for major global financial assets. Going back here, and the US, this is the second column right here. It says over the past 50 years, the annualized return when you adjust for inflation has been around 7.5%. When I teach about the S&P 500, I say between 9 and 10%, but that's not necessarily counting in inflation into that calculation. I'm just looking at a numbers basis. And this kind of proves it out that in the long haul, you do get a pretty decent return on an annual basis. Then retail sales down in 2024 so far. This could have some impact on the economy since retail sales really influence the economy to a big degree, but we have been falling back after we saw a real spike up. And then looking at the Case-Shiller home prices, that's the blue line. And this is the increase in income that people are being paid. And this is just pricing a lot of folks way out of buying a house right now. And with inflation where it has been, I've even been reading some things about people are even having trouble paying rent because it's just so high right now. Then benign inflation in May strengthens our confidence in a return to 2% in 2025. Okay, these folks at Goldman Sachs, they can come up with whatever forecasts they want, but they think inflation has been coming down, and then they're forecasting it will get down to that 2% level. I didn't find anything on Twitter. Everything's all about the debate and everything. There really wasn't any useful charts that I could see. So here is the intraday chart where we had a nice strong open. We gapped higher. We got above R1 right off the bat. We climbed above R2 and then just kept going. R3 was right up here. It was at 54.27, I believe, just a little bit above where we were at. But then we stalled out right at this level at around 55.20. And then this was normal at this point. You see a bit of a pullback, although these bars are kind of scary with how fast they're going down. We tried to level out here. This was around the 5,500 level where kind of went to battle there for a while. And watching this as it was unfolding, it looked like, okay, this is what the market's really fighting over right now. Well, at least for right now, the market lost, or buyers lost. We ended up going down below R1. We got all the way down to the unchanged level, hit the daily pivot, tried to bounce up off of that. Now, this could have been a time, since we filled the gap, we came down to support, and if the smart money was going to come in and start buying, we would have seen a nice little run back up. That didn't happen. It started to. We got back up to the 54.90 level and then came back down to the daily pivot. When it was obvious we weren't going to see any kind of a breakout, that's what brought sellers back in. We came down below S1. We did go a little bit below S2, but it didn't last for very long, and we closed just a little bit above S2. Intraday, not really much to show. The market was really waiting to see what would happen. And the big move up that we saw was after the core PCE was taken as positive by the market. We're still looking pretty good here. The blue line is still above the red line. That means growth is outperforming value intraday. We saw a little bit of a hit here on the S&P growth to value ratio where it was down overall. And then our end of day charts, growth was down where value was up. Growth was also down with the mid caps where value was up, and it was up, but up less for the small caps. So not necessarily a really good day for growth. So our growth to value ratios for the small caps saw a decline. We also saw a decline with mid-cap growth to value ratio, a little bit of a decline, but holding up a bit better here when we look at S&P growth to value. A little bit of a pullback when we look at our growth to value ETFs. We came down, but we're still above the rainbow when taken together. Going sideways with discretionary, saw a little bit of weakness here with staples, so that's why we saw the ratio going up. Large cap growth coming off, it did have a new intraday high, all-time high, but then ended up closing pretty much at the low. And then we were looking better here when we compare large caps to small caps, but this really came down since small caps were up as large caps were down. The Wilshire, again, set an all-time intraday high, but then closed not at the low, but near the low for the session. But looking here at our chart, it's hard to see this, but the green line's actually turning back up. So the ADX is picking up something positive. We are going up. We're above the moving average with the ADX, and we're above 20. So this is a trending environment, and we're in a positive environment, at least for right now. It's a little easier to see here on the short-term chart where the green line is turning back up. We are also in a trending environment. One thing to be a little concerned about is we're getting kind of close to this 40 level. Now, I know we haven't really been doing much here. We've been chopping sideways with the S&P, but if we have some kind of an upward move, it would not take very much for these lines to become extreme positive. We did really see a pickup in volume because of what day it was. Sentiment was pretty much flat with the Ulster Index. We did get the latest reading from Investors Intelligence at 3.32. That's still positive since it's above 3. We ticked up, not very much. The VIX didn't move all that much on a closing basis, but it was up with the down day. And we closed kind of at the higher 2/3 of the bar here when we look at the bar chart. And this is kind of strange on a down day to see the VIX actually decline on the bar chart, but we closed near the high for the session and we were pretty much unchanged, but under the moving averages with the line chart. We're rolling over a bit here with the momentum of the VIX, but with the up day, it hasn't quite crossed below as measured by the MACD. We did decline with the equity put call ratio, even on a down day, but now we're starting to go back up with the 5-period chart, and that tends to be more negative. We're still very high when we're looking at the volatility risk premium right now. This indicator is suggesting there's a lot of fear in the market. Our other indicators are not suggesting that. We did really advance with this fear gauge. This other fear gauge, we actually declined slightly, so a little contradiction there. Then looking at the euphoria meter, this is when you take the forward PE, the VIX, and the bullish percent or bullish sentiment, and you put them together. We're getting to a pretty high reading now. We're going back into about the year 2000. We're about at similar levels there, and that usually marked kind of some bad things after that. So we'll have to keep an eye on this to see if sentiment is getting a little too complacent. It's like everybody just assumes the market's going to go up, and that's often when things can change, at least to shake up everybody's confidence. But when we look at the advanced decline line based on price, we're still seeing that negative divergence. We have not broken out above this previous high, but we were up on a down day. And with volume, we're holding up better. We're not really seeing a decline. This has been chopping along sideways. And with the new highs, we did with that gap higher open and that initial thrust up, we saw an expansion of the new highs. So we're barely turning back up with the 5-period, and we're trying to turn back up with our 10-period internal measure here. And this is a little positive too. The blue line is just barely above 0. That's positive, where the red line is just barely positive too. So on a down day, to see the advanced decline ratio show a little improvement is encouraging. But when we look at our smart money indicators, we're coming down, but still above the moving average with accumulation distribution. We also decline with the Chaikin money flow. The Chaikin oscillators declining, but still positive. And our cumulative NYSE advanced decline line, this is where we saw some more broad market strength. We actually were up with this indicator. And when we look at our regular NYSE advanced decline line, we're advancing and above the moving average. So that's holding up a bit better. This other NYSE advanced decline line is also above the moving average and advancing, not by very much, but holding up. And then we look at the common stock based on price for the advanced decline line. It did turn up with the NYSE, and we also went up based on volume. When we look at the S&P, just kind of chopping around with the cumulative advanced decline line based on price, but holding up better when we look at this based on volume. The NYSE advanced decline line did show an improvement, so we're showing a little bit of change here when we compare it to the S&P 500, not the negative divergence that we had been seeing. But when we look at our advanced decline line studies, we're still above them, or excuse me, below the moving average with the common stock, still barely above with the S&P. Showed some improvement with the mid caps and small caps, but still below the moving averages. Here's our short-term chart. Really didn't hit this upper resistance. We weren't quite there as far as we weren't going to hit that intraday. We would have had to go up a lot higher than what we went up. But so far, we've really just been chopping sideways. The discouraging part is that we set the high near the open and then pretty much closed at the low. On the bottom, we saw a real spike up in volume. So we are already extreme negative with the Stochk RSI. And we're still extreme positive with the Stochk RSI, even though we're coming down in the short term. We're declining in the intermediate term, but still extreme, declining in the long term, but also still extreme positive. We're hanging in there for right now with our 20-period double and triple exponential moving averages. Now we're below them. If we can get those back, that'll keep these lines going back up. If we continue to fall from here, these lines are going to roll over, and that could put the short-term trend in jeopardy. But when you look at this, with the 20, 50, and even 200-period moving averages, we were up on a down day for the S&P. The force index is just barely crossed over negative, just giving just a slight negative reading now. We're still above the plotted moving averages here with the 20-period. So the short-term trend is still up, and we're still above the moving averages. We came down, and we're right on the border between the +1 and +2 channel for our standard deviations chart. So we're not extreme. Intermediate term, we came down, but we're still positive with the balance of power. We actually switched back over to positive with the go, no-go system with the darker blue bars. We're still above the midpoint with the highest high value. This is a little more negative. With the TTM squeeze, we're turning to a darker shade of blue and starting to decline. But when we look at the 50-period double and triple exponential moving averages, we're right in between the two. If we can get that back, this is going to keep the red line on top. This is showing us what the intermediate term trend is looking like. We were flat, but still positive with the ease of movement. We actually advanced with the Erin indicator. Go figure. This thing kind of thinks for itself sometimes. And we're still negative here and showing a divergence with the S&P McClellan oscillator. We came up, which is positive on a down day, but we're still below zero. So our summation index based on price and volume continued to decline, even though they're trying to flatten out a little bit lately. But we crossed over positive with the NYSE McClellan oscillator. Now, not by very much, but we are above zero. And it's hard to see, but we're just barely starting to turn up with the summation index for the NYSE based on price and volume. But you have to use a magnifying glass to see that. Turning more negative here with the Swenlin trading oscillator. We're dropping below zero and declining. We're looking a little better based on volume and just barely positive here, but we are looking more negative with this. The momentum is really slowing down, but we're still above the moving average of the PMO. And we're looking more positive when we break this out based on price. We're still looking negative based on volume. So with our studies, we were pretty much flat with the PMOs that are rising, still going up a little bit with the buy signal, still looking flat with the PMOs above zero. And we remain neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. We came all the way down to this dot. Now, one of the things that this chart is used for is not only direction, and I consider this a primary indicator. If you use a thing called stop loss orders, this is where I initially set them. And then it's called a trailing stop loss. And I teach about this in my course, where it only lasts for one day. And then the next day you put it right around the value of these dots. And then eventually it comes down and gets hit. So if you did set a stop loss, you probably got stopped out. Then looking at the slope, we are starting to turn down below the moving average after being extreme positive. The MACD is also starting to look a little more negative. So we're seeing some turning and rolling over here in the short and intermediate term. A little bit of a rollover with the KST, not quite down to the moving average with the tricks. So our momentum is really not looking as positive as it was. but we're still above all the plotted moving averages here. We actually showed a little bit of an increase with the bullish percent index, but not anything all that convicting. Even with the upward thrust near the open, we didn't really see this going up, but it's still positive. We're declining with the NYSE bullish percent index. We're actually up a little bit here with the NASDAQ 100 bullish percent index. The money flow is declining, but still above 50. But when we look at the ultimate oscillator, we've now crossed below 50. So that has turned negative for the intermediate term. The vortex shows the green line on top, but declining. So it's positive, but not going in the right direction. The RSI 14 and 9 are no longer extreme. We've dropped down with both of those charts. And we did decline, but we're above the moving average with the on-balance volume. And we're just barely back above 50 with our 20-period moving average study of those stocks in the S&P. That's slightly positive for the short term. And our study showed a little bit of an improvement, but we're slightly negative now in the intermediate term. We've dropped a little bit below 50 with those stocks inside the S&P above their 50-day moving average. A little bit of an advance here with those stocks above their 100-period moving average and a bit of an advance above the 200 moving average. So some of the negative divergences, yeah, they're looking a little bit better, but they're still there as negative divergences. We're starting to cross over negative with the Copic curve. This is another momentum oscillator. The Pring bottom fishers, for some reason, still on a buy signal. We're no longer extreme with the Sean trend meter and are seeing it decline. We're still negative here with the 5-period moving average of the highs minus the lows for the Amex, NASDAQ, and NYSE. So being below zero, that's more negative for the broad market. And this is positive, though. We closed just barely above the R2 level. We didn't lose it. We cleared it a week ago. That's positive sign number one. So far, we've been able to hang on to that. Now, this level is at 54.51. We closed at 54.60. So we're what? 19 points above that right now. Not anything great, but this support level has still held for right now, and this is longer term. When we look at the fib extensions going forward, we really haven't come back. We tried to test this previous high in here, but it was quickly rejected. And then our different charts, we're seeing more almost like a doji type signal here. We closed and opened at about the same spot with the Heikin Ashi. We're still looking positive with the Kegi and the Renko and the 3-line break. So the trend is still looking okay for right now. Long term, we did tick up a little bit with the 150 and 200, but we're not extreme with these readings. Still seeing these longer term negative divergences as they were going down while the S&P was going up. We're just negative with the mid caps in the short term right now. Everything else remains positive. And now we're negative with bonds based on price in the short and long term. No changes that I could see with the decision point scorecard. And this is kind of interesting. We see a lot of blue or green right after we open because everything's all-time high, 5,500. Yeah, every party time. And then everything shifted, and then we ended up seeing a lot of red as we got closer to the close. And as far as the sectors, real estate, energy, the financials and industrials were up, with utilities really leading the way down. That's an area we've been keeping an eye on. And we're looking okay here with the new highs minus the new lows. This is just a raw score from day to day. We're above zero. It would be nice if we could see the red line start to turn back up. And we saw a little bit of an improvement here as the broader market held up a little bit better compared to the S&P. So our ratio came down a little bit, but it was really the mega caps that were sending this ratio up. And now that it's falling back, you could take that as positive since the mega caps saw some profit taking. And the Dow ended up being down 0.12%, still above its 50-day moving average, still above this big P right here that's right in the way of seeing the bar. We continue to be neutral with the diamonds when looking at the Elder Impulse system, and we came up a little bit above this pivot level, and then we reversed after that and ended up closing below that. We're still looking okay longer term. We're above the 50-period moving average, and we're still in an uptrend. And with the NASDAQ 100, we also got back to this previous high, and then things started to turn and go down after that. But still looking positive longer term. We continue to be neutral with the Elder's Impulse system for the Qs, but the momentum for the NASDAQ 100 is now starting to look negative. And here is the fib extension chart. Came right back up to this previous high. I was watching this as it was happening. I have to tell you, I dumped on some long positions right when we got up to this level because it looked like we didn't have enough strength to really get through that. In the weekly chart that had been looking scary, well, I'm not sure how scary it looks now. It's just not looking very positive, where we opened and closed for 2 weeks in a row, pretty much where we started. The small caps, they were up, but they really haven't improved. They're just still underneath this pivot point, still underneath their 50-day moving average, but they continue to be positive with the Elders Impulse system for the small caps. We did get back above the 50-day moving average with the Russell 2000. We're above 50 with the RSI, and the momentum is actually starting to turn more positive. Can we see some more follow through here? The mid caps really chopping sideways and not showing the leadership strength that they were showing earlier on. We're still below the 50-day moving average, but they are positive when we look at the Elders Impulse system for the mid caps. The total US stock ETF, it did set a new all-time intraday high, but closed pretty much at the low, where Apple was down 1.63%, but still seeing a relatively new uptrend. Tesla was up 0.25%, but still can't get above its 200-day moving average. NVIDIA was down 0.33% here, but still looking pretty solid after pulling back. Microsoft was down 1.3% after setting an all-time high. Meta was down 2.95% after looking pretty solid lately. Amazon, which set a new all-time high, fell down 2.32%. And Google was down 1.76% after setting an all-time high. Netflix was down 1.38%, but still holding up fairly well. The FANG index did set an intraday high, but closed pretty much at the low, and that's usually not a very good sign. That's why we're putting up some warning flags about weakness potentially entering the market. The financial sector was up 0.33% and starting to get back above its 50-day moving average. We're continuing to decline with the staples to tech ratio, and that is positive. The dollar was down slightly, but it's still in an uptrend, and that could be putting some pressure on stocks. The market likes a weaker dollar. When we look at the correlation between the S&P and the world index, it's starting to improve in the short term, but still trailing off with our longer term correlation. Looking at the staples sector, they were down 0.44%, coming back down to their 50-day moving average, seeing a little bit of an improvement with the relative strength momentum, as well as the ratio between the two, but they're still both below 100, so that's more negative. The utilities were down over 1%, coming back down to their 50-day moving average. So the momentum is declining. Sorry, the relative strength is declining, but the momentum still continues to be positive. Healthcare is above its 50-day moving average, seeing a little bit of an improvement with the relative strength as well as the momentum. And energy cannot seem to get above its 50-day moving average, even though it was up. We're seeing an improvement with the momentum as well as the relative strength. Bonds, we saw a real uptick in the 10-year yield, which was pressuring stocks later in the day. Earlier in the day, interest rates were down. So we saw a real kind of nasty decline here with the 10-year based on price. Saw a little bit of an improvement. We're still above the moving average when we look at the Qs to S&P. Discretionary came down, but is still above a declining moving average. We came down, but above an advancing moving average when we compare large cap growth to large cap value. So the large caps declined, but still above the moving average. We're still above the moving average with the mid caps and dropping below the moving average now with the small caps. When we look at the advanced decline ratio based on price, we're just barely positive. We're about right on the zero line, where we're looking a little more positive when we break this out based on volume. We're continuing to go up with the S&P to utilities ratio. That's positive for right now. We're still declining with our staples to S&P 500 ratio. That's also positive. So what's our outlook for Monday? We are still positive. These negative divergences, some of them are showing some improvement, but they're still there. The internal and broad market strength, we're just not seeing an awful lot of follow through to this point. And now we have to ask this question: is weakness starting to come into the market? We're going to get, okay, this is incorrect. I don't think we're going to get anything from Monday. I'll show it on the next slide. And we want to keep an eye on the geopolitical events. Kind of the big one right now is what's happening within the whole presidential election and what may transpire with that. Then we will, oh yeah, I should have put this on there. We're going to get the ISM Manufacturing Index. That's a big one. That'll be coming out on Monday, as well as construction spending. Later on in the week, we're going to get a whole slew of reports coming out on Wednesday, including jobless claims. We're going to get the FOMC meeting minutes later on. And then the market's going to be closed for Thursday for July 4th. And then we're going to get two big reports on Friday, the employment situation report and then the non-manufacturing ISM. So this is highlighting what will happen in Monday's session. Seasonality, we are looking positive for July 1st. It's the beginning of a new month, a new week, and a new quarter, so people might be sticking some money into the market. So looking at the last 73 years, we're up almost 59% of the time. We're down about 41% of the time when you take all of these together. I'll deal with the expiration week when we get there. But the Dow, S&P, and NASDAQ are positive across the board. And this, though, is not really showing any real positive seasonality during an election year. And we might see a little bit of a bounce here going into the 4th of July. And Monday is the most positive day of the week. So we might have that to look forward to. And then looking out a little bit further, we're now coming into July, where we might see some initial strength at the beginning of the month during an election year. We're also wondering if the 12-day mid-year rally for the NASDAQ, which should already be starting now since we're finishing out June, is that going to carry over into July? And then we're also, this is more of a negative thing, where we're seeing a real diversion from where the S&P has been going compared to what it historically does during an election year. This is a new chart just highlighting July now, where we're positive on all the different time frames. This kind of ugly brown area, that's going back to 1950. The blue are the past 20 years. The past 10 years have been the most positive, and then during the election year actually are positive, but the least positive. So what are our warning signs? Just keeping an eye on the staples and utilities. Okay, that seems to kind of be a focus, and then it drifts away and then kind of starts to come back. We're kind of at the away stage right now. Also keeping an eye on energy and healthcare. Advanced decline lines, they're not really breaking down, but they're not showing an awful lot of strength right now. Growth to value and discretionary to staples, they're just not leading the market higher. And we do still have the S&P McClellan oscillator as well as the summation index, which are negative. And the Swenlin trading oscillator, had to switch that over to this slide. It is turning negative. It's already negative based on price. It's barely negative based on volume. Our oscillators are also, I had to put this on the list too, starting to turn more negative. The equity put call ratio is going up based on 5 days. The ultimate oscillator has turned negative. I don't know about the weekly chart for the Qs. To start and end about where we were at for 2 weeks in a row, you might be able to make that look or sound a little bit scary. And then the momentum for the NASDAQ 100 has now turned negative. We still have a lot of positive things, though, with the parabolic SAR, even though we came all the way down to that dot. If we see more follow-through weakness, that chart just might end up changing over to negative. Accumulation distribution, the Chaikin money flow, and Chaikin oscillator. Yeah, we saw some weakness in those areas, but they still continue to be positive. And the NYSE McClellan oscillator and summation index, they are positive now. And that's a broader market measure. The bullish percent index, it's above 50 and just ticking up a little bit. Not seeing an awful lot of strength, but still maintaining a positive reading. The money flow, the vortex, yeah, the vortex is positive, but the green line's coming down. The topic curve is positive, but just getting ready to cross over negative. Pring bottom fisher, don't understand, but it's generating a buy signal. The financial sector is okay, and the bullish percent index, actually, it's not declining. We were up a little bit in Friday's session. So our conclusion, we're still positive for right now. These negative divergences are still there. I'm going to be doing the intermarket analysis video over the weekend, and that's where I really break out the different sectors to see if we can see what's going on and seeing if there's some rotation there. Is the strength on the broader market, it's holding up, but is the strength in the S&P, is that starting to go away, or is that going to come back? And so we have to ask, is weakness developing? In the short term, we're positive, but declining. But the short-term trend is still positive. Intermediate term, again, this is where we're seeing a lot of these negative divergences. Some are improving, some are not improving. We'll be watching over to see if there's some kind of sector rotation and if the strength is starting to go away. But again, we have to ask, is weakness starting to come in? In the long term, we're still positive, but we have those longer-term negative divergences between the 150 and 200 period moving averages. Thank you. I hope you have a wonderful weekend. I will be preparing the weekly videos, so I will talk to you in the next video.